All right, we've hit that time in which we will bring in Brett Manning. I almost called you a Brett Trader, but you all know him as Chart Trader, aka Brett Manning. And Brett, first and foremost, good morning.
Good morning, Jim.
So, I gotta ask you, have we
All
hit
right.
have we hit the bottom? Why or why not? We're
All
in the
right.
business. It's a funny business we're in because if you think about it, we are in the
Yeah.
business of predicting the future, and that our livelihood pretty much depends on it. So we need to be able to forecast this. You do a good
Oh,
job because you break it down pretty well, where you've got the if-thens and all the contingency plans and whatnot. But I just figured I'd just jump right off the bat and say, hey, is this the bottom?
my bias right now is trading to the long side.
Okay.
I'll say that much. So we got a big put order that came through right off the open today that was pretty significant, I think, and lagged in the data for quite a while. But I also, I kind of got that sense just yesterday afternoon that it was a real kind of first-level washout.
Mm-hmm.
And now, the tape that I'm watching right now, I really do see, I mentioned this really late. I actually took a bounce trade really late that didn't work out, and it was before the margin selling kind of kicked in. But I am seeing in the tape just a lot of big market orders slapping down into the bid in the futures. And I think that that's just like, there's a trigger happy sense right now, I think, in big bears in the index plays where they know if they can just slap it a couple times, there's a bunch of money that'll fall out of the bottom of the market, and just kind of keep doing that over and over again. And every time the downside momentum stops, let it bounce a little bit, and then just start to slap it again. And there's that momentum, and anybody who is, starting to dig in on the long side can very quickly be shaken out of those positions. And when you see that become super persistent, and then you start to see a bid hold against it, that's usually when you have some upside, and I'm seeing that today pretty rampantly. We just had a high, if you look back at the around 10:30 or so, where you see a lot of tails pop up on short time frame charts, and we kind of knocked the market down a little bit. I almost took the long into that. And I really should have, because I felt that it was pretty clear that that was kind of, a lot of overly aggressive index shorts coming in at that level, looking to basically stop the market at the retest of the overnight highs, or just a mild overshoot of the overnight highs, and the very early morning highs, and to turn things back around and start to bang it back down and go for yesterday's lows. And there's a bid that came in and held pretty well, and the squeeze that we just saw, I think, is just simply, you're starting to see the psychology shift a little bit, where people who are doing that on the short side are lining themselves up to get hurt. So that kind of, shifts the nature of the tape a little bit and allows people to get a little bit more conviction in coming in and buying. And then, we're starting all of the big mega cap high growth story earnings reports this afternoon. So, I still think there is this, we went through a chip stock kind of really tough tumble after Texas Instruments and then AMD, and you just got the sense that there's a chip cycle turn that's already happened. But for some of these plays like, Amazon, I don't think that that's happened in Google, and you really need to separate those out. And I still think you've had a really strong Q3. You're going to see some really big numbers from these guys, and it's going to be tough to get too much more downside momentum, probably right in the thick of that. But I don't think that we've seen it's a bottom, we're headed right back to new highs. I wouldn't say that.
All right. Well, then, so what do you suspect is the next, I don't know, the next scenario that you see setting up? Where is the next point where you would say, okay, now the buying's been overdone, I might look to short a pop or something?
Well, I want to first talk about what's happening.
Okay.
Because I think that that's the main question. What's happening? What's going on right now? Is it just, a random pullback? Is it a scare because of geopolitics, or what's really going on? So in that context, I think when you get a sense of why we're seeing such extraordinary sudden downside momentum, seems a little bit out of the blue. Earnings actually are on the whole are going really well so far this quarter, in terms of just beat the number stuff. So what's really happening, and what I think is really happening, is a combination of something I talked with Gavin about last week and something I talked about quite a bit in April. And I think there's a few things coming together here. One, we basically, the way that I would put it is, we spent our fiscal safety net on rocket boosters at the top of the cycle. And that, I've talked about this for a few months, that's a big issue because there's no monetary safety net really. The Fed is not that. I mean, when you start cutting, the cuts are much bigger than the hikes. You do not cut 25 basis points every 3 months. Something starts going wrong, they're going to cut 75 basis points and then 100 basis points. You're going to be at zero in no time if we start to see a cycle turn. And we've already gotten to the point where, people don't really have a lot of faith in QE. There was a psychological impact, but when you get past that, you do it enough, and people start to see it's just the Fed and Treasury kind of playing cards in the corner. It's not really a tremendous amount of support, and we're going to be running trillion-dollar deficits next year. So I think part of what's happening right now is people sense that they are walking on a tightrope with no safety net underneath. And that causes very easy shifts to sudden extreme risk aversion. There's no put. There's no Greenspan put. There's no Powell put. There's no Washington, D.C. put. There's no put. So if it starts to go wrong, you're playing without a net. So there's one thing. And the other thing is we're going to have, because of that same process, because of spending the fiscal safety net at the top of the cycle, we're going to have what Gavin and I called a comp nightmare in 2019 because of juicing things up in front of midterms, especially if, and the polls are still calling for the Dems to win the House, if the Dems win the House, because there's not going to be a next leg of fiscal stimulus. So when you take away the next leg of fiscal stimulus and you juice the numbers, now you're looking for some really difficult comps when you're talking about next year. And then finally, the other piece of the puzzle here is what we talked about a whole lot back in April, which is dividend yield on the S&P 500 is 1.94%. Now, if you go back to 2016, that's the best yield you could get. Everything, the 10-year was way under that. If you're somebody who needs yields, you were out of the bond market and into the stock market. Even people who, for 50 years, were running funds that would never be in the stock market had to be in the stock market in 2016. It's what held us up then. You had 0% interest rates all around the world. And you've got people who have future obligations like pension funds they have to pay out. They have to get some return. And they are getting negative yields on their money in the bond market. That forces all these guys into the stock market. Now we've got 1.94% yields, and we've got interest rates that have powered higher. So you can get twice that, on all over the place. So it's not really, there's none of that money underneath this market anymore on pullbacks. There was a lot of that money underneath this market on pullbacks previously. So because of the rip higher in interest rates, you no longer have what I've always called the refugees of the bond market. They're no longer refugees camped out in the stock market. They are back living in the bond market at this point. And they've got no reason to change that probably for a long time. So that was one of the pillars that was supporting us on declines. And then the idea of the Fed being able to do something, that was one of the pillars. And the idea of the potential for fiscal stimulus was one of the pillars. And all those pillars have been knocked out from underneath this market. So whenever we see something like a comp nightmare coming in front of us, you're going to see an air pocket, a manhole with no cover on it in the street of the market, right? And we're just going to drop right through it. And that doesn't mean we're heading into some kind of terrible crash. But it means the next year is probably not going to be very good for people who are just camped out along the stock market and hoping we just keep ripping to new highs. That next level, we would need a new something to come along and change that narrative, a new major tax cut or something, which would really, I think at that point, just make the eventual outcome worse because of what that would do to deficits. So the market needs to know there's a contingency plan if things don't go as hoped, especially when they're going to be coming into a period where comparisons are going to be really difficult. So I think that's the main way to look at what's happening right now. I don't think that it's necessarily going to be that bad on the downside, but I do think, much to really my kind of joy a little bit, is that this is going to be an environment that probably does allow us to see a more consistently high VIX, because you don't have that put underneath the market, and because we are going to see the occasional difficult comparisons in numbers. So you're going to see these little air pockets from time to time, and you're probably going to see, I would imagine, a net negative year if you're looking October to October of 2019. So but I don't think we're going to 1,000 on the S&P, anytime soon. So it's not like this is heading into some kind of terrible universe, and I think it's a fantastic universe for traders.
All right. Well, guess what? Just as we say that, we've got Blue Chip Trader went out with a short in the DIA, so the Dow ETF DIA. Let's see. This one is trading 24 spot 30-ish right now. He says he can't really put his finger on it, but he feels this bounce might be too easy to be buying after yesterday's sell-off. So a little bit of a dichotomy. Oh, then I think he just joined us. What's up, Blue Chip?
Hey, how are you?
Hey, Scott.
Hey, Brett, how are you? So, Brett, maybe you can confirm this or not. Doesn't this seem so obvious of a rally today after yesterday's sell-off?
So the way I characterized it is that I think shorts had gotten into a pattern of really trying to hammer the bid for the last 24 hours because it's been working so well. And if I look at the Dow futures, basically same instrument you're trading, when I look at the highs around 1030-ish, it looks like there was a lot of that going on, and it didn't work. And so the pop that we saw was them getting blown back out.
Right, so and that's where I'm going and fading that pop, because now I feel like bulls...
Which could work for you. Yeah, I don't know if you're going to get new lows, but I think you're going to get something.
Yeah, I don't think, again, the volatility is so high, like you just stated.
Yes.
This is a great short-term day trading scalping market. If I get a new low back down to 245, 246, I mean, that's a home run. If I get a buck or two, I'll be happy with it, just to check back to the opening ranges. So, but I just feel like there's this definite game of cat and mouse going on here where everyone thinks that the seller should reload and then they don't, and then buyers are jumping back in because it didn't work. But now I feel like sellers are still going to kind of pound everything.
It's that wonderful thing, Scott, that's called serial correlation. Everybody's reacting to what just happened, and it makes trading so much fun. Yeah.
And exactly. And I think you almost have to fade. It's like you have to be one step ahead of everybody, and then you have to fade that next development. It's such a weird. I don't know. But today's. I'm looking at the action today, and I'm like, really, the Dow's up 350, and you have and everything. Advanced decline lines rising, and everyone's a buyer today. I'm like, I don't know. I'm going into midday, and I'm like, I think I want to fade this rally. The downtrends are still in effect on that intraday basis on pretty much every single time frame, whether it's a 5-minute time frame or higher. Everything's still looking pretty in favor of selling into rallies. So I figure, maybe the 249 is not the exact entry point. I'm still willing to hang around here, 249, 250. If they start lifting things above 250, 251, then I think we're going to have a lot more downtrends broken on like a 60-minute time frame, and that's going to kind of have me, thinking that there's some more legs to this rally. But yeah, overall, I think it's just worth a nice little potential day trade here to short this market midday and see what comes about here as we move further into the afternoon.
Spoken like an exceptional technical trader that you are.
Appreciate that. Thanks. All right, let you guys get back to your little talk about stuff.
Yeah, the markets. Let's talk about those.
Talk about charts. I'll jump right in.
All right. So let me ask you something, Brett. Something that I've noticed, and I've been dabbling in this as of late, and I don't want to go all Al Bundy on us and everything and talk about the old glory days of the early 2000s and whatnot, but the stock market is not the only game in town when things start to heat up in the VIX, and I've noticed a lot of opportunity in the bond futures market, so the 30-year, the 10-year, trading the knob that being notes over bonds. For anybody out there who doesn't know, you can trade those spreads, and they've been the liquidity in those futures contracts have been a lot. People have gotten back in. Yeah, right? The bond market itself. Yeah.
Oh, yeah.
6 months
great
ago.
trading market. The VIX is up in the bond market.
Well,
look at it that way.
Yeah, is there a VIX for the bond market? I don't even know.
I don't know if there is. There probably is. But, I mean, you can imagine what it would be like right now, given the move that we had to the downside in bonds, to the upside in rates, starting a couple weeks ago that really kicked off this whole sell-off. I mean, you could just look at the bars. If you just look at the bars in, let's say, the 30-year, they're just much bigger bars now. There's much wider ranges.
There are wider ranges, but what I have also noticed is that there's a lot more players in this party now because I would say even 6 months ago, if you looked at the bid offers on the 30-year bond, let's say, they were like 100 up. Now they're 700, 800, 1,000 up, and the 10-year has really gotten a lot.
You mean the size of the inside market? Is that what you're talking about?
Yeah, just the size
Sure.
on the bid and offer. And so what you have is a lot more players involved, and therefore a lot more opportunity. Let me see. In the 10-year, they're like 4,000 up. It wasn't that long ago that those were only like 100 up, 200 up. So there's a lot more participation in them, and I'm guessing that I think my personal opinion on that whole thing was over the course of the last 10 years or so, the Fed has really choked that market. And I know a lot of old prop traders like myself who, we started at the CBOT and we traded a lot of these. We really got suffocated out of the market because it was just a bunch of guys fighting over the same crumbs. It looks like there's a lot more big pieces of bread out there, and I want to throw that out there for those who are in there. The bond market can be a very good day trading market, especially
and everybody out there. I mean, you could just look at just add to your menu of tradable instruments. Even if you don't like futures, just TLT is becoming a good trading instrument. That's just another way to look at it. Like that's something that's starting to get more movement, more volume, etc. So you can tap into this from all sorts of angles. But yes, this is a period where there's greater volatility in the bond market, and people are going to go to where there's greater volatility, especially if there's liquidity. There's always going to be enough liquidity, and once there's a foundation of enough liquidity, when volatility kicks up, you're going to see a ton more volume, just like you say, on the inside market.
For sure. All right, so. You know what we've not even talked about over the course of the last couple of weeks, and we've seen pretty good volatility and movement, and that's crude.
Yeah, right, and I still don't really fully understand the forces at work there, other than, so I talked with Gavin about this last week. There is the whole geopolitical issue, but then there's probably a more simple cyclical analysis. And basically, it's holding the range that we talked about, right? 75 being the top of the range, 65 being the bottom of the range.
Yeah.
And it is almost back down to 65 after being up just a hair over 75. So, I mean, I would just continue to look at that as maybe, it is actually, this leg of it has been more active, but when it's in that type of context, I tend to not trade crude as much. There's not as much imbalance. There was the fade at the highs, I think we were talking that day, would have been the trade. And otherwise, when you start to get back into the middle of that range, it's a little tougher for me to be pulled into looking for setups. But it was a pretty potent top. And we do have some cyclical headwinds, and those comps are going to be economic as well as earnings-based. So you're going to see probably some pricing in, some discounting of a decline in demand growth on a second derivative basis for the crude oil market, which is probably what's behind this decline more than anything that has to do with Saudi Arabian geopolitics.
Yeah, well, we are. I'm got the daily chart up for crude oil, and just as let's see. Well, I mean, we did almost test 77, but really, for the most part, the most.
If you scroll that back, you'll see just essentially a back and forth.
Right, between 65 and 75, absolutely.
Yeah, about 3 legs in at this point, and that, I don't know if it's going to change. I mean, at this point, since it was such a rejection, we might undercut that last set of lows and maybe see 62. But we'll see. We're under the 200-day now for the first time in quite some time.
Well, the thing about this one is we've not even talked about it, and I think if there wasn't so much going on in the stock market, we'd probably be talking about this a lot more, because I think the rate that this has moved from 75 to 65 has been pretty fast, all things considered, don't you?
Well, it's volatility in oil too. It's volatility in everything. It's just everything is just starting to move a lot more. People are a lot less confident in their understanding of the value of things.
Well, and that sets up two-way trading, which is good for
Absolutely. I mean, I've been quiet the last couple of days because, as I said, like pretty much every time we come into earnings season, I'm going to be a little more quiet during the first week of major earnings. It's just always how it is for me, because I feel like there are forces that I may not understand underneath the tape, because I don't have a tremendous amount of confidence in, there not being some kind of a little bit of leakage of information, and I don't know how to gauge that, to what degree that's happening, to what degree people are basing decisions on, new research that's just emerged about what they think is going to happen after the close. We got Google and Amazon coming out We had, Microsoft and AMD and a bunch of others yesterday, and we've got a lot of big earnings reports starting. It's really the thick of it, and I tend to get I have a little less conviction in pattern structure when I feel like there's so important fundamental information that's just coming in front of people. So I tend to wait until we get kind of a sense of, well, I believe most market participants have a sense of, basically how this earnings season is playing out. When we've put enough of the narrative down that we start trading in reaction to it, for the most part, then I think the charts start to become more reliable. So I tend to be a little more quiet. However, we got a VIX above 20, so I've definitely been taking some trades. But I think, generally speaking, I think that one of the consequences of the entire process that I discussed earlier, it can be boiled down to a difficult time understanding the value of assets and the range of the sort of give or take range around your understanding. It's a little tougher to dig your heels in, and it just ends up being a wider swinging market across most assets. And for me, that's music to my ears. So that is a period I think that's going to be much more interesting from a trading standpoint over coming months.
If I won't hold you to it, but if you could speculate, how long do you think this can last? What would you give it? I mean, is this a 6-month thing? Is this a couple of year thing? Or how do you size this up? As far as the opportunity that we're seeing with an elevated VIX.
Yeah, I mean, I will say that my base case scenario, which I know will be wrong, would be looking out the next 3 to 4 quarters. But it's not going to always be 25. It's just that the downside is going to be 16 rather than 9. And that's the difference. It's just a different range. The downside is going to be higher than the downside was. And there's a little bit more edge to patterns. There's going to be a little bit more, movement through levels and snapping back around them when that kind of thing goes on. It just simply introduces more opportunity to traders who are able to exploit those opportunities, especially on a intraday time frame. You're just going to have a little bit more in the way of opportunities. It's not going to be so boxed in by people who are so absolutely confident that such and such price is too high or such and such price is too low. That confidence level goes down. There's a little more wiggle room around the edges, and you can exploit that. So I think that is something that's probably, I would guess, going to be with us for a few quarters at this point, because you're going to go through this process of having no safety net and poor comps. And I think that's what we're heading into. Now, could it be worse than that and longer than that? Sure. Could it be better than that? Sure. I don't really know. But that's my expectation at this point. This is not one of those where you've got the VIX above 20 for a week and then you're back at 9. Although we could get one of those. Quite frankly, if this is a top of some form, not saying we're heading back, down 60% or something, but if this is a top of some form that's going to be with us for a bit, topping is a process. You don't just go right off a cliff. You go seemingly off a cliff, and then you find your balance, and then you go back up most of the way. Chop around quite a bit, and you rebuild that sense of everything is fine, and then you start down again, and from a lower high. That is almost always the process you're going to see in a situation like this. Is that maybe we're putting in the first low now, maybe we'll put it in a few days, maybe we'll see some negative earnings surprises that'll help that happen, and then you'll rebuild until you get back the confidence where people don't feel like this anymore. People aren't searching the internet for, but probably the search rankings for something like stock market crash has just gone through the roof. When that goes away, when people start to feel like, oh, you know what, that was just another one of those things, only the high is a little bit lower. And we saw something similar toward the end of 2015, if you recall that period, where we had the August crash, then we came back up until we got to the point where everybody was just like, things are fine again. And then we had essentially the January crash. But as I said, at that time, we had 0% interest rates across the curve everywhere. So we had this enormous underpinning, this enormous safety net, where you've got just massive amounts of money that would normally want to be in the bond market that had no place to go because it has to get a return. And so every pullback was bought up aggressively in anything that had any kind of dividend yield. So that just supported the market. It kept that from being any deeper. In this case, we don't have that same safety net. So I would imagine, if you imagine something like we saw in late 2015, early 2016, happening over coming months, and then a bit of a lower low on that tail where there's not quite as much support. But, I'm not looking for something tragic and catastrophic by any stretch of the imagination. I just think at that point you'll start to see those comps coming through, and you'll start to realize that, if the worst case scenario doesn't have a safety net underneath it, the way that we have in the past, so it will lead to a little bit more volatility in that process, if that makes sense.
Yeah, it does. Now, the next point I want to kind of get your ideas about. I think yesterday you highlighted that we dipped into negative territory on the year in the indexes. Okay.
Just barely.
Okay.
Right.
So now we're up. Let's just call it. Well, now the Nasdaq's up 3, but it kind of gave fund managers an opportunity to reset, or maybe if they were savvy enough, they could have hedged well enough to actually have a good profit. And let's say
it's possible,
you've got your fund manager who might be up 8-10%, and right now that looks really, really good. Okay, 2 months of the year left.
All right, I see where you're going.
We've got a index kind of reset. We've got some people who may be, hey, you know what? I'm going to call it quits on the year. I'm just going to tread water, and everything will be fine. I've made my year. I'm going to just basically check out. Now,
there's another big character in your story. The bigger character, in my opinion, is the people who panicked out of all their positions here.
Okay,
and as the market starts to grind back higher, suddenly we're looking at a market that could end up 8 to 10%, and they're nothing. And they're chasing.
Well, you killed my drama, man. I was building it all. I was building it all up, and you had to come in and undercut me. But yes, that is the big character. Yes, yeah. I wanted to know that chase scenario, and then what happens? How does that play out?
I go right back to exactly what I said before about 2015 comparisons.
Mm-hmm.
So we had the August crash, and then we started to find ourselves. We had a tremendous amount of hedging come in. Now that one big difference here is if you go back and look at 2015, we did not have what I would call distribution. We had fear and hedging. And then we got some distribution, particularly in half the market. That period was characterized by half the market falling completely apart, namely materials, commodities, energy stocks, crude oil. That was the big crude oil crash, down to $26 a barrel. And that was, people were wondering if it was like the banks in 2008. And of course, we made the argument that it's nothing like that because they produce oil rather than credit. So it does not have the same systemic effects for the economy. In fact, it's good for the economy because it makes energy cheap. But the big difference there is that half the market completely fell apart, but the other half of the market did not. But if you look at the S&P, it was relatively mild as corrections go. But we had that period in, let's say, November and December, especially first half of December, where I think we got exactly that. People got scared out. They overhedged. They hedged everything away in August, and they became convinced that what was going on in the let's say the heavy industrial side of the market was going to eventually contribute to everything else falling apart. And so they were late getting back in, and by the time we were rallying higher toward the end of November, it was just a chase into year end among portfolio managers who realized, they'd hedged away all their gains for the year, and now the market was going to end up, coming back. So I think that was definitely a contributing factor in how we behaved toward the end of that year. And I would have a tough time not seeing some of that happen again here too, even if we see the Dems take the House, we see a kind of sense of, there's not going to be any more fiscal stimulus, there's not going to be another tax cut, there's not going to be, et cetera. It's not going to be an easy time deregulating things. Eventually we acclimate to that a little bit, and the market seems to be holding up a little bit, and people start to say, hey, maybe Q4 numbers are going to be a bit better than we projected, and you get this, little bit of a bump into year end. And the big difference maker will be, I would imagine that's going to be a lower high. And we will start to roll over then early next year as you start to look at some of these comps, because there's no way that you're going to have companies coming into, the end of Q1 and the end of Q2 showing anywhere near the same kind of year-over-year growth that we saw this year. no chance of that. And that's got to price itself in. And again, if you start to see that contributing to people, I think somewhat wrongly we're seeing an implosion of the business cycle or something, because I don't think that's what it is. Just the fact that there's no safety net down there on the contingency that might be what it is, if we're having a cyclical rollover with, maybe 3 Fed cuts, no QE, and no fiscal stimulus, that's a scary proposition. So I think that it leads to more risk aversion, which leads to a little bit more of, a slippery time in putting in lows. So I think that, you can see this year-end bump, and then you can see another rollover, and you can see it get a little bit worse than we saw in early 2016 in terms of the actual downside that we get in the market. So that's my expectations at this point. That's a base case scenario. That's kind of like a sketch of my expectations, and my expectations are highly mutable. And I just kind of check reality against them each step of the way and it's good to have an initial kind of sense of what I'm expecting, but in no way am I going to put in place some kind of strategy that is unchangeable, that assumes that's what's going to happen, and I'm just going to stick to it no matter what. I mean, I'm highly flexible in that, for better or for worse. It evolves over time. But that's where I'm at right now.
All right. Yeah, I was going to ask you if you could handicap that, and sounds like, I don't know, 60, 65% you think that would probably be the base case scenario? That's what I'm kind of speculating anyway.
60, 65% what?
That we have the scenario you just laid out.
Yeah, I think it's going to be 61.8%.
Well, all right. Look at you, fancy. I'm going to rename you Diana Ross.
I love that,
Yeah. Well, you kind of are the diva of the group.
Really?
Well, it can't be me.
Well, no, that's fine. If you want me to be, then I'm in.
Nah. Anyway, that's what Gavin told me, so you blame him.
Oh yeah, I knew it.
All right. So we've already checked in on the bond market, the crude market, equities. What's going on in currencies? Anything you're liking yet?
I mean, we've got not much of a rally in the yen, which is pretty interesting, given everything we're seeing. It's like not much of a rally in the bond market, right? I mean, the traditional way in which the markets used to respond to a gigantic spike in the VIX just isn't there right now, and that's pretty interesting. Obviously, the other big thing going on here is what I see as an increasingly intractable appearing drama in the relationship between Italy and Brussels. Rome and Brussels, really not finding any common ground whatsoever, and both having to dig their heels in for their own internal reasons. Italy, because their entire new paradigm of this new wave that they have, in power in Italy, it's there, predicated entirely on the basis that it's not going to give in to Brussels, but somehow is not going to exit the euro. And Brussels is faced with a situation where if they were to let this happen the way that Italy wants it to happen, they would be getting a call from Portugal, Spain, Greece, Ireland, like the next day. And wondering why, Italy gets special treatment. It's like me, I've got triplets, right? And if I start to, a couple years down the road, if they all really want toys when we're at Toys R Us, and I only say, hey, okay, Alex is crying a lot, so I'm going to give him, the fancy spaceman blaster guy. But Sophia and Sylvie, you guys do not get toys because you're not crying as much. That's no way to that's not a workable solution to that situation. Whether or not it's just that Alex has that toy isn't even part of the question. If that's the way that I'm running that situation, then I'm going to have a lot of problems in the future. And I'm sure that Brussels knows this. So for both of them, there's my way or the highway, and I don't see how that doesn't eventually lead to some exit threats. I don't understand how that's possible. It will have to be Italy giving in the end, and they will have to find a way to make it look like they're making good on their promises. I don't see any other possible outcome, but so far they're digging their heels in further and doing a really good job of throwing the steering wheel out the window in the game of chicken. And that is something that's definitely contributing to what we're seeing, particularly in the bank stocks, because they have all been, looking at a cycle that has been strengthening in Europe, who is going to be taking getting out of 0% and, starting to hike rates, and there's a cycle going there. And when that happens, if you look historically since the birth of the European Monetary Union, when the cycle strengthens, the interest rate spreads between the countries converge. It's just a basic quantitative strategy that all the banks are involved in. German yields and Italian yields will come together during periods when you're seeing the cycle accelerate. So they're all sitting in that trade on some level at the same time that this is happening, and the spread is blowing wider and wider and wider. So the bank stocks are getting crushed. That's definitely part of what's going on in something like the KBE. And if that turns into exit threats, you're going to start to see those credit default swaps fly and, all sorts of stuff. So there's part of everything that we're seeing has got a little bit of that in there, but I don't think it's obviously not, it doesn't explain all of the volatility that we're seeing across the market.
Who is the official the official figurehead of the Italian government? Is it the president, prime minister? Do you know? Not who it is.
It's shared responsibility. I mean, we got Gavin hanging around. I'm sure he could tell us intricately.
Yeah,
but
I will ask him.
I look at it just like sort of like there's this group of guys who've come in, and they've come in and they're making decisions kind of together. Pretty much on the same page, and part of that is because of the way that they put this together. But you've got Mattarella and Conti and Di Maio and a couple others that are kind of involved on a ministerial level, and there's a philosophy there that is essentially rooted in populism, and they all kind of reaffirm it because that's the new. It's like in the U.S. when we had the big turnover, the establishment giving way to the Trump administration, and there was kind of just a whole. I mean, the difference is so striking in terms of look at the cabinet in the White House versus what we had with Obama. It's just a complete change in the underlying paradigm, and in a frankly a similar direction in terms of populism. But the populism. If you're there because of populism, then you won't be there long if you give in to something like this, like pressure from some larger establishment that is not in the short-term best interest of, or at least can't be pitched to the average voter as in their short-term best interest. For instance, having to take some pain to get out of a big budget hole isn't really why you're there in populism. Populism is, we deserve a break. And you guys have been working hard enough, so you're going to get everything you want now. And that really sells with voters, and that's why it's populism, because it's popular. And, in a system as complex as the Eurozone and the way that everything is tied together, you can't have one country that's a part of that shifts to populism and have it work. I mean, it's on just a 30,000-foot level, if you just look back at the situation, regardless of whether populism is right or wrong, you can't have one member of a rules-based structured system start to basically say, we're not going to take it anymore. We're going to do things a different way. And it's going to mean that we're going to get greater allowances and greater leeway than other members of this group. And, everybody wants, their cake and eat it too. Like, everybody's going to want that. That's a desirable state of affairs when you're given the choice of that or the old Eddie Izzard Act of cake or death. It's a pretty easy choice. And, you offer that choice to people and you say this is legitimate and you deserve it, and that's how you get into power, is by offering that choice. Then when you come up against it, you got to deliver something that you can at least frame as that piece of cake. And I just don't know how that's going to happen. So I think that there's a lot more drama to come there rather than a very quick and easy resolution. The only way that there could be one is if the people on Italy's side gave in, because I can't understand how you're going to come up with a rule. I mean, look, just not to go too much more into this, but I'm very interested in it. And I think that one of the issues is, the one way out of it, I suppose, would be for people in Brussels to put together some kind of new rule that applies to everyone, but that only manifestly applies to Italy right now. But it feels fair because everybody has access to the same rule. It's for everybody, but somehow it's tailor-made just so that it applies to Italy right now and probably won't apply much at all anytime in the future, and so they can make it seem like greater allowances for Italy right now fall under new rule 127Z8 whatever. And that is not because we're giving in to Italy, it's because there's this rule that everybody has access to, only it only applies to Italy right now. And because of how complicated the process of rulemaking is in Brussels, again, a parliament made of, people from different cultures and different countries who don't even speak the same language in a lot of cases, and take probably longer than any other bureaucratic institution in the history of mankind to change anything. Look at Brexit. You're not going to get a quick resolution to this process if that's the way out. So the only other way would be Italy giving in, and as I just said, that's unlikely too. So either way, things have not yet come to a head there, and they're going to. And that will become a more important issue in the probably months to come. So there,
yeah,
big
well,
EU-Italy thing.
I've got my Italy safety net plan. You ready for it?
Oh gosh, go for it.
Mario Draghi runs for prime minister or president or whatever it is that's the head, and he'll take care of everything for everyone.
Well, obviously, yeah, no, good point too.
I'm only half kidding on that one.
Yeah,
I don't really know his agenda, but it seems like that could be. I mean, he's Italian.
Yeah, that's true.
And
He's Italian,
and he does whatever it takes to get everything done.
He does.
Wouldn't he be among a favorite if he were to run?
After things fell apart, yeah. So let's say things fall apart a bunch more.
Well, that's what I said.
Then,
safety net plan.
Yeah. You've got to first get everybody to go, oh, this whole thing that we're doing now doesn't work. And then they give up on this. And then they're looking for some kind of efficient, technocratic kind of, seasoned guy who really understands Brussels well to come in and take the reins. Then sure, but he doesn't seem like the kind of guy who wants to do that. Because, running for any high political office in this day and age means a lot of fart jokes on Twitter. And that's not fun.
Well, yeah, but I mean, the ECB is running the ECB. He's definitely had his fair share of.
He's been through the Twitter mill.
I mean, he's. I don't know what would you call him? The second most powerful, central banker in the world. I mean, that's pretty high prestige there. So, running Italy would probably be a vacation for him.
There you go. I don't know if Italian politics is a vacation for anybody.
Well, it would be for him.
I'm enjoying the narrative.
But, anyway, that's months down the road, and it's not a thing until it's a thing. So we can talk about it and prepare for it, but until,
My point is, it's going to be a thing. There's going to be a thing.
Well,
thing will happen.
And then it'll last for a week, and we'll talk about the bond yield blowing up, and then all of a sudden we'll talk about the boon being a good trade for a couple weeks, and then all of a sudden,
probably
things are back to normal. So, all right. So the markets that you are eyeballing are.
I mean, it's just getting past a little bit of earnings season before becoming more aggressive, but looking at index plays and looking for my general sense that we're going to see probably something similar to, and this could be completely wrong again, but I still see that kind of, we're going to have this rebound that's a little more dragged out, and we may see the VIX move back down again, but when the VIX moves back up again after that rebound, then I think really it's going to be a party for traders for a bit. And, that could actually be into early next year. Hopefully it won't take so long. But right now, it's pretty fantastic in terms of where the VIX is at and that it's kind of sustaining itself there. And probably, as I said, I think the low end for the VIX now is not going to be 11 anymore for years. The low end now is going to be 15, 16, and we're going to be able to see some 20 to 30 VIX numbers here and there when we see the downside. So that's just going to be a much more interesting market, and I'm likely to be probably much more active as a trader than I've been over the past, really 12 to 18 months into September has been a slow trading period for me, just kind of staying with longer term strategies and trying to, not try to dance too much when the music isn't playing because of the knowledge that at some point the music is going to really start playing again. And I would say I'm starting to hear that a bit now. So.
And let me tell you from past experience, if that is the case, then the day trading profession just keeping it very loose becomes back. It becomes a thing again, and
Oh yeah.
and that helps traders as well. And I'll tell you why. The thing about deflated VIX like that is your margin of error is just so limited because the opportunities are just so scarce. So if you're like you've noticed, you'll have 2 or 3 trades and you're like, well, I tried these ones out, the pattern set up, but it just didn't work out. But now you might be able to do those trades, the same setup, 5, 6, 7 times over the course of a day with lower risk and higher reward, where when things get moving, you get that immediate gratification. You're like, oh, taking profit, boom. So it just sets up, and it's a nice cascade effect of greater opportunities, greater pockets
Music
of time.
starts playing louder and louder. But again, I want to go back to it's a consequence of the VIX being down, but it's not the VIX being down. The thing that causes that is the sort of intraday cycle of emotion of the what I call serial correlation. Because the moves are wider, because it sustains itself that way, because the opportunity is there for day trading, people start to more of the market, the pulse of the market is defined in terms of people reacting to something that just happened that didn't have to be caused by some kind of new tweet by the president or something. It's a market, it's an endogenous phenomenon in the market, the movement. And people start to focus on that and react to it. And so it becomes linked together. What happened an hour ago to what happens over the next hour becomes connected up. It becomes correlated with itself, serial correlation. The market becomes correlated with itself through time. So the patterns become much more defined and much more important to what happens. What the market's just done causes what the market's about to do. When you have a very low VIX, all that's gone. There's no pulse to that concept at all. It's a bunch of individual decisions being made for individual reasons, and then occasionally a big headline suddenly causing everybody to pull back risk. And then it goes back to being this very individual, separated, independent decision-making engine rather than being correlated to itself through time. It just becomes much more random and noisy in terms of pattern structure. So the signal-to-noise ratio becomes terrible. And the signal-to-noise ratio for pattern-based trading, very active trading, goes through the roof when you get that high serial correlation. And it is the size of the moves and the emotion that's underneath the market that causes that to come into place. So as we start to see more opportunities and more movement and people feeling, and again, I said this to you before a number of times, but I think the fundamental cause of all of that is just how people are wired. We are wired as like a herd animal, a pack animal, and when there's something that we don't understand, but we know it's really important, we take cues off each other. And I think you see it in all sorts of emergency situations that people just started, everybody's running in the same direction. I better start running in that direction too, because I don't know what's going on, but it's probably bad over there. And that, we're just wired that way. We're wired as a survival instinct to queue up at what we're doing. And that plays into markets when you start to see important moves in markets that really boil down to being billions of dollars in market cap for all sorts of things, constantly in flux. People start to take cues off of what's just happened and make decisions based on what just happened without knowing why. And that just becomes the music. That's the music. And when that music is playing, that's when you want to be a lot more active as a trader, and that's when the opportunities, provided you understand that's what's happening, that's when the opportunities are much greater.
The other thing that we didn't see throughout this little mini correction here, I guess a real correction, I call it mini, but there's a reason why. We didn't get a VIX that just went up to like 40, 50 or anything like that. I was looking back, and, back in 08, let's say, and again, things were way worse, but the VIX was, it shot up to like 80, 90, something like that.
You didn't do it all at once, though. It waited until Lehman.
Well, sure, of course, but even back in, I believe, March, right? February, March time frame?
That was the short VIX implosion.
Right.
Important to remember that.
Okay, but even in late, kind of the later end of 2015. Yeah, we had a VIX in the 40s and 50s.
So, and that's really important. So as I said before, I think that the difference between what just happened now and the difference with what happened in August of 2015, now it's this distribution feeling. And in August of 2015, it was this panic and fear and hedging. And that's when you're going to get, you're exactly right, a much more dramatic and immediate spike in the VIX because people want to keep their portfolios but be protected against a crash. And that's exactly what the VIX is measuring. It is measuring, the options market for the SPX and the applied volatility. So people are taking, catastrophe hedges in, and by pricing them, bidding up further and further out strikes on puts for the SPX causes the VIX to go up. That's exactly, what we were seeing was it's a massive hedging. So generally speaking, a decline that's going to be more sustained, you usually do not see the VIX go up. You see it go up only at the end when people are starting to rush for insurance based on what they don't want to sell. It's not just that the VIX goes up when the market goes down. The VIX goes up when the market goes down, but people don't want to sell their stocks. Look at it that way. You don't insure what you don't want to own. If you know you're going to sell something, you don't buy insurance on it. So put call works similarly. But yeah, we're seeing a higher VIX. It's pricing in more volatility, but it's not a panic.
Right, and that's what I wanted to highlight as encouraging, that this may have some legs to being a good trading environment for quite some time. So I was hoping to get that. I was really trying to pull that out of you, that we could have a long.
No, I mean, I agree. And if you just look at the downside leadership, it's small caps, banks, transports, and semiconductors. Like, that's not something that heals quickly.
Hey guys.
Yeah.
Sorry, Gavin here. Just breaking in real quick. I just wanted to point out that the Clarida headlines are coming across. It's the vice chair, of course, his first time speaking in public, so a little bit more waiting here. But he's back behind this. Some further gradual Fed rate adjustments would be appropriate. Noticing that inflation isn't running out of control, wage growth remains consistent with productivity levels, and sees high savings and lower taxes as a tailwind for the economy. So just pointing that out as rates are down around that 3.12 area in the 10-year, and markets under a little bit of pressure here, so could be a notable inflection if we see the market shake off these. So sorry for interrupting, but I did want to get that out for people.
Good point. Thank you.
No problem.
All right. Well, I was just looking back to see if we had any questions. Don't really see anything that we should address. So unless there's anything else, any parting shots that you have, I think we'll take a pause from our conversation and let you be free to find some good trading setups or anything else that you might have in store.
No, I mean, I just think, this is probably going to be a more interesting trading environment going forward, but don't be surprised if we see some seeming rebuilding of confidence that, this was all just a bad dream, and then, if that stops at a lower high and starts to roll over, probably it's after that point that it really turns into something far more interesting. This is the first shot across the bow. Topping is a process, but I think that based on what we talked about, just to sum up, you can have some really difficult comps coming up. You do not any longer really have a safety net as far as the refugees of the bond market holding up the market, buying high-yielding stocks on any decline because of what's moved in interest rates. You also have higher cash levels, generally speaking, for the risk parity portfolio management side of the market, which we're talking about $500 billion there, simply because bonds and stocks aren't acting as a dual hedge. The stock market and the bond market has been going down together or up together, which is typical in a late cycle context. So there's some things that will shift in the plumbing of the market that take a little bit of the safety net away, and then the tightrope walker in the circus that I described in my chart book back in April, you're probably not going to see the same premium valuations. You're not going to see the same multiples given to stocks when the market is aware that there's no new fiscal stimulus coming and there's no safety net underneath. And if you imagine, just a useful heuristic is to imagine, or I think I use a trapeze artist in my chart book. If you imagine a trapeze team in the circus, when there's a big safety net down below, think of the types of tricks they do. Right? Triple flips all over the place. But when you take away the safety net at the end of the performance and the drums start to roll and the lights go down a little bit and there's a hush in the crowd, they just kind of go from one side to the other. And that's amazing because there's no safety net and they could die if they fell. So it's just, the tricks end up being much less dramatic when there's no safety net. And you can kind of think of that as, what's the average multiple going to be over a period where you're looking at that? You know, probably a little bit lower because it's just amazing to be doing okay at all, you know, when there's no safety net, because the consequences of things falling apart are much worse. So that will cause, I think, lower premiums, lower multiples for equities over that period, just simply because of where deficits are at. So it really does, you know, I know it sounds boring, but it really does kind of come down to fiscal policy, deficits, and interest rates. And it's probably just going to lead to a market where we see more volatility and what I think is going to be a really spectacular period of trading.
Well, we can hope so. I'm certainly hoping for it, and I'm sure most of the listeners out there will be looking forward to that too, as you know, we all looking for opportunities to make money. And speaking of, it looks like Blue Chip Trader is making some money on this Dow short. So, you know, you had a bullish slant. He had a slight bearish shorter term slant, and he's taking some profits on that one.
Nicely
so
done.
it's good for 1 point. So look at that, good back and forth trading. Things are heating up, so that's good incentive for everyone to keep on listening in.
Got it.
All
Thanks,
right.
Jim.
Well, thank you so much, Brett.
All right. Take care.